Welcome to Section 7 of our ASC 470 Debt Accounting course. This section is where everything comes together: the journal entries, the balance sheet presentation, the income statement treatment, cash flow classification, and the disclosure requirements that auditors and investors actually read. By the end of this section, you will be able to record any standard debt transaction, present it correctly on the financial statements, and know exactly what disclosures a SC 470 requires. Here is what we will cover: 5 objectives, and they build on each other. First, you will be able to write the journal entry for any standard debt scenario: borrowing, interest, amortization, repayment, extinguishment. Second, you will apply the effective interest method confidently. Third, you will know exactly where each debt-related number lands on the financial statements and why. Fourth, you will know what the footnotes must say. And fifth, you will spot the classification traps that catch even experienced accountants off guard. Let us get into it. Most people assume every debt entry is complicated. Here is the simplest case so you have a clean baseline. When a company borrows $1 million at par, meaning the proceeds equal the face value, you debit cash for $1 million and credit notes payable for $1 million. That is it. No discount, no premium. The carrying amount equals the face amount from day one. This entry is the foundation. Everything else we cover is a variation on it, adding complexity for issuance costs, discounts, or premiums. Keep this clean picture in mind as we build on it. Here is where it gets interesting. Watch out for this one: issuance costs are not expensed immediately, and they are not added to the face value either. Under a SC 470, issuance costs reduce the carrying amount of the debt. So if you borrow $1 million but pay $10,000 in legal and arrangement fees, your net proceeds are $990,000. You debit cash for $990,000, credit notes payable for $1 million, and carry the $10,000 as a contra liability called unamortized issuance costs. The one exception: revolving credit facilities. Those costs sit as a separate asset on the balance sheet. We will see why that matters when we get to presentation. Most people assume bonds are always issued at face value. They are not, and the accounting difference matters a great deal. When the market rate is above the coupon rate, the bond sells at a discount. You receive $950,000 in cash but record bonds payable at the full $1 million face value, with a $50,000 debit to discount on bonds payable. That discount is a contra liability. It reduces the carrying amount. Flip it around. When the market rate is below the coupon, you collect a premium, more cash than the face value. The premium sits as an adjunct liability, increasing the carrying amount above face. In both cases, the balance narrows to zero by maturity through amortization. Here is the key thing about interest accrual: the number that hits your income statement is not the same as the cash you pay. That is the whole point of the effective interest method. Each period you calculate interest expense as the carrying amount multiplied by the effective rate multiplied by the fraction of the year. You then credit interest payable for the cash interest, face value times the coupon rate. The difference between those two numbers is your amortization. For a discount bond, that difference is a credit to discount on bonds payable, which shrinks the contra liability and pushes the carrying amount up toward face value. For a premium bond, it is a debit to premium on bonds payable, which shrinks the premium and pulls the carrying amount down toward face. This mechanical process is what drives the carrying amount to exactly face value at maturity. Let us run through a concrete example so the mechanics are clear. A company takes a $1 million term loan at 8% per annum, 5-year bullet maturity, with $15,000 in issuance costs. The net carrying amount at inception is $985,000. Each month, cash interest is $1 million times 8% divided by 12. That is $6,667. Issuance cost amortization is $15,000 divided by 60 months, $250. Total monthly interest expense is $6,917. Notice that the expense is higher than the cash outflow. That difference builds up over 5 years until the issuance costs are fully amortized at maturity. This is exactly the pattern you will see on any term loan with closing costs. Early extinguishment is where a lot of entries go wrong. Here is the logic. You are retiring debt before maturity, so you need to remove everything from the books, the face value, any remaining unamortized discount, and any remaining unamortized issuance costs. Then you record the cash actually paid. The difference is your gain or loss. In our example, the bond carries at $972,000. That is face value of $1 million, less $20,000 of unamortized discount, less $8,000 of unamortized issuance costs. The company pays $985,000 in cash. The shortfall, $13,000, is a loss on extinguishment. It shows up as a separate non-operating line on the income statement. Watch out for the issuance cost write-off. People sometimes forget to include it in the calculation. Reclassification is one of those areas where the stakes are high and the rules are strict. At the end of every reporting period, you pull the portion of long-term debt due within the next 12 months into current liabilities. That is a straightforward debit to notes payable long-term and a credit to current portion of long-term debt. But here is the scenario that trips up even experienced teams. Suppose a company has a $2 million term loan and violates its debt service coverage covenant at year-end. The lender gives a verbal assurance that a waiver is coming. Under a ASC 470, verbal assurance is not a waiver. The entire $2 million must be classified as current at the balance sheet date. If a written waiver arrives before the financial statements are issued, you can reclassify, but it has to be in writing. This distinction has failed audit tests more than once. The balance sheet presentation rules under a ASC 470 are specific, and deviations draw audit comments. In the current liability section, you show short-term borrowings, the current portion of long-term debt, and any bank overdrafts. In the non-current section, long-term debt is shown net, meaning after subtracting unamortized discount and unamortized issuance costs. So the balance sheet number is the carrying amount, not the face value. Here is the one exception worth remembering. Revolving credit facility issuance costs do not get netted against the liability. They sit as a separate non-current asset on the balance sheet, often labeled deferred financing costs. The logic is that a revolver has no fixed borrowing, so there is no liability balance to net against. Keep the current and non-current portions separate at all times, never lump them together. 2 financial statements, 4 classification decisions. Get these right and the numbers flow cleanly. On the income statement, interest expense sits in the non-operating section and includes everything: cash coupon interest, discount or premium amortization, and issuance cost amortization. If you extinguish debt early, the gain or loss gets its own non-operating line. Do not bury it in interest expense. On the cash flow statement, proceeds from new borrowings and principal repayments are both financing activities. Issuance costs paid also land in financing activities. The one that surprises people: interest paid is classified as an operating outflow under U.S. GAAP. That is the default, and it differs from IFRS, which allows interest paid to be classified as either operating or financing. Know the U.S. GAAP default and be consistent. ASC 470 is explicit about what the footnotes must contain, and investors read these notes carefully. The core elements start with a plain language description of each major debt arrangement and its outstanding balance. You must disclose both the stated rate and the effective rate. They differ whenever there is a discount, premium, or issuance costs. You need a 5-year maturity schedule showing the principal due in each of the next 5 years and thereafter. Any collateral, real estate, receivables, inventory must be described, and covenant disclosures are mandatory: what the covenants require, whether the company is in compliance, and if not, what remedies or waivers have been obtained. Omitting any of these is a disclosure deficiency, not a minor technicality. Beyond the core disclosures, a ASC 470 requires several additional items that often get overlooked under deadline pressure. Unamortized issuance costs must be disclosed along with the policy for amortizing them, straight line or effective interest. Any significant modifications, refinancings, or extinguishments that happen during the year need narrative description and quantification. If the company borrowed from a related party, a parent, affiliate, or key executive, the terms of that arrangement must be disclosed if they are material. Convertible debt carries extra requirements: the conversion feature, the conversion price, and which accounting model was applied. These special items are where footnotes become genuinely informative. They are also where disclosure deficiencies tend to cluster, so build a checklist and work through it systematically before each filing. Revolving credit facilities deserve their own slide because they break the standard netting rule. When a company pays fees to establish a revolver, those costs go to a deferred financing costs asset, debit the asset, credit cash. Each period, you amortize that asset into interest expense just as you would for a term loan. But on the balance sheet, the asset sits in the non-current section on its own line. It is not netted against the revolver balance. The reason is practical. A revolver is drawn and repaid repeatedly, so the outstanding balance fluctuates constantly. Netting an issuance cost against a balance that might be zero today and 50 million tomorrow would distort the presentation. Knowing this exception prevents a common misclassification on the balance sheet. Let us pull it all together. Every journal entry in this section follows the same underlying logic. Record what you received, what you owe at face, and net the discount, premium, or issuance costs against the carrying amount. The effective interest method is not just a formula. It is the mechanism that reconciles cash flows to carrying amounts over time. On the balance sheet, debt is always presented net, except for revolving credit facility costs which sit as a separate asset. When a covenant is violated, the classification rule is unforgiving. No written waiver means the balance goes current, full stop. And disclosures are not optional detail. They are a required, material part of the financial statements that readers depend on. Thank you for completing this section on journal entries, financial statement presentation, and disclosures. Thank you for watching. Subscribe for more training from PNJ Group.